mentions and thank yous. Oh, and during the, I think I'm getting out of order here on my thing. Okay, I'll go in my order. So want to thank the steering committee members, the CFOs, Darren Heffernan, CFO at Trintech, Emily Taylor, CFO at Naturally Slim, Meg Taylor, CFO at Independent Bankers Capital, Alan Bueller at CIC Partners, and Robert Ruff, Managing Director at Telos. Additionally, we want to thank the sponsors, DLA Piper, Mr. Stephen Bartz, partner, Holmes Murphy and Associates with Matt Brost and Kyle Working, UMB Bank with Dennis Wright, and Weaver with our esteemed moderator Brian Reed and Elisa Martin. Please know that these committees are run entirely by that group and paid for when their expenses entirely by the sponsors. So please consider the sponsors as you need different business services throughout your tenures and your positions. We sure would appreciate that. During the presentation, per the CPE requirements, we have to determine that you are alive and breathing. So we will be performing 4 polling questions. If you want your CPE, you have to answer at least 3 of the 4 questions. You don't have to be smart. You don't have to get it right. You just have to answer them. So we would appreciate it if you make sure that you answer them so we don't get a bunch of calls of why I didn't get my CPE, which is something we always get lots of calls on. So during the, as I said before, during the presentation, you can send your questions to the moderator, Brian Reed. Brian will pick up questions as Brian sees fit and interject them. And then at the end, we'll have about a 5 to 10 minute Q&A session where he will also read them. During that time, you're welcome to click on raise your hand during the Q&A at the end. And Brian might call on you, in which case we will unmute you so that you can verbally ask your question. Okay, here comes the exciting part. It says you must read this or this will not qualify for CPE. So this is going to be exciting. Today's webinar is worth 1.0 continuing professional education CPE credits. To be eligible for CPE credit, you must answer at least 3 of the 4 polling questions during the webinar and have a total viewing time of at least 50 minutes. This is all tracked. Participants will receive a CPE notification email when the credits are available, typically 7 to 10 business days post-presentation. We are unable to grant, however, we are unable to grant CPE credit in cases where technical difficulties preclude eligibility. So hopefully we don't have any technical difficulties. CPE program sponsorship guidelines prohibit us from issuing credit to those not verified by the technology to have satisfied the minimum requirements as stated. In accordance with the standards of the National Registry of CPE sponsors, CPE credit will be granted based on a 50-minute hour. So that is our required statement. I appreciate everyone joining us. And at this time, I will hand it off to Mr. Brian Reed, who will kick off the introductions. And at this point, the 50-minute time period commences. Thank you so much.
All right. Well, thank you all for everyone for joining us for today's program. And we all really appreciate y'all's joining us. So should provide some excellent insights into the current M&A market. So we will jump right in and start our introductory of our panelists. So I'm going to go around sort of the horn, so to speak. We'll start with Chris Godwin, who's the managing director with GMCAP America. Chris, you want to spend a couple of minutes sort of telling everyone about yourself, your firm, anything else that would be relevant to sort of your introduction?
Yeah, sounds good. So GenCap, I'm with GenCap America. We are based we are based in Nashville, Tennessee. We're a lower middle market private equity firm. We've been around since the late 80s. We've invested in close to 60 odd deals over the years since that time. Our investment strategy is very focused on a specific internal dynamic at any given company. We look for generally basic businesses, a lot of distribution companies, manufacturing, and some services type businesses. But what all our companies have in common is stable cash flows, long histories of profitability and earnings. And we are generally looking for a situation where the primary owner is looking for a liquidity event, often looking to also exit the business as the primary operator. And we look very closely to find out if there is an internal management team that has been with the company for a significant period of time that is backable to become the operating partners with us in any given deal. We do very well where the owner, often the founder, is very concerned about the legacy of the business after they depart, wants to feel like that they leave the business in good hands, that their employees and their management team is going to still be there in 2 years and still be a part of the business. And so we exclusively partner with those internal teams to help run the business for us. We're currently investing out of a $250 million fund. We have currently owned 21 portfolio companies nationwide, anywhere from the West Coast up to the Northeast and anywhere in between. And look forward to participating in the panel today. Thanks.
So next, will Kyle Madden with partner with KLH Capital. You want to spend a couple of minutes kind of giving an overview of yourself and the firm?
Sure. Let me unmute myself. Can everybody hear me? Okay.
We're good.
Perfect. So my name's Kyle Madden. I'm a partner with another private equity group called KLH Capital. We're based over in Tampa Bay, Florida. We manage a little bit under $300 million across a couple different funds. We look to find opportunities where we can invest for either a less than 50% ownership stake or a greater than 50% ownership stake. So what we find ourselves doing is getting called on when, let's say there's multiple different owners, multiple different shareholders, one or two want to retire or want liquidity, so we'll issue a minority deal, or if a single shareholder or a majority of the owners want a liquidity event, we can do a majority deal. So we've been around since 2004. We'll focus on companies that are making or earning about $4 million to $15 or $20 million of EBITDA. Typically, we're towards the smaller end of that, kind of 4 to 10 million. Like Chris's shop, we'll go coast to coast. We own 8 different companies right now, or we have investments in 8 different companies right now. Some are minority, some are majority. We are good within the industrial services, commercial services sectors. We've done a lot of maintenance and repair-oriented contractor business models. And we'll focus on value-add distribution businesses. So that's really where our skill set is. But what we're looking for is those management buyouts, the generational transfers, or the recapitalizations where, like I mentioned earlier, there's a need for liquidity to accomplish something. And that something could either be a partnership looking to retire or one partner looking to sell. But the key for us is that there's a continuing management team. Maybe they're an owner today, maybe they want to be an owner, and we can structure that deal so the non-owners become owners. And really we're more listening to what they need and then providing them the money, the people, the technology, the resources to build the company that they fall asleep to at night. So it's quite a fun gig, and happy to be here.
So we had I didn't expect a question this quickly that's probably relevant to the introduction as opposed to sort of the actual program itself. So quickly for both Chris and Kyle, there was a question about sort of what size check does each one of your firm typically write, and I'm sure that just depends on the facts and circumstances. But in broad terms, what does that look like in terms of investment types or investment size?
Yeah, the actual check that the fund will write will be anywhere from 10 to 25 million. And then we'll look to source an amount of debt on top of that. So our transaction values are anywhere from, say 20 million to typically 60 or 70 million, but the actual check coming out of the fund is typically 10 to 20, 25 million of equity.
Okay.
Along the same lines, for us, the range tends to be the checks we're actually writing anywhere from 5 to 35 million for the equity that we're doing. Enterprise values, that tends to equate anywhere from 10 to 75, 80 million or so. If we do have larger transactions, the investors in our fund are typically big pension funds and are very excited about co-investing if we ever have a situation like that.
Okay, thank you. So now we'll move on to Robert, Managing Director of Telos Capital, and I'll let you spend a couple minutes or a minute or so giving your background.
Thanks, Brian. Robert Ruff, Telos Capital Advisors. We are a boutique investment bank located here in Dallas. In fact, we cohabitate with Connexus, Eric Holloman's firm. So if you know where that is, that's where we are. We have a couple of things that we do. We sell companies for people, and we'll sell them to people like Kyle or Chris. We also raise capital for companies, and that tends to be a little bit more interesting because it can cover a lot of different issues. We will raise capital for companies or for independent sponsors or executive teams who want to buy a company. We will raise capital to take out partners, a minority, as Kyle kind of described, or we will raise capital for restructuring a company's balance sheet. And as many of you can probably imagine, there will be a number of companies who, because of COVID-19, have reduced, let's say, operating income and EBITDA, and that if they have debt, their creditor, be it a bank or be it some sort of senior lender, may require them to go out and get junior capital. We can assist in that. We raise money from institutional lenders or institutional investors. Usually it's 3 million or so at a minimum, up to probably about 40 or 50. Brian, to your question, on the sell side, normally the companies we work with have a valuation of somewhere between 8 and usually about 50 million, although we sold a $300 million company within the past couple of years. So that's us, Telos Capital Advisors.
Very nice. So certainly, last but certainly not least, Steve Bartz is partner with DLA Piper. I'll let you spend a couple of minutes or a minute or so kind of giving your background, and then we will jump into the questions.
Sounds good. Thank you, Brian. And thank you everyone for joining us today. Greatly appreciate it. So I'm Stephen Bartz. I'm a partner in the Corporate and Securities Practice Group at DLA Piper. DLA Piper is the third largest law firm in the world. We have offices all across the U.S. and worldwide. We're one of the few truly global full-service law firms. We have a very deep bench and broad expertise as well across jurisdictions and industries. So with respect to DLA Piper's corporate and M&A practice, it is highly regarded by Chambers USA Guide, and the firm is ranked #1 in global M&A deal volume for 10 consecutive years. I personally specialize in alternative entities such as LLCs and partnerships with a focus on mergers, acquisitions, and dispositions, as well as joint ventures and private placements. Frequently find myself working on behalf of private equity sponsors on the fund formation side, working with management teams to get private equity dollars, and then representing portfolio companies in connection with acquisitions and dispositions. That's my practice and DLA Piper in a nutshell.
I'm gonna interject one
All
thing
right,
real
very
quick,
good.
Brian. So the polling questions will come up during the discussion. Just keep the discussion moving. People just answer the polling questions. So I forgot to state that up front. So thank you.
Okay. Okay. All right. So I want to say that if you have a question that you'd like one of the panelists to answer, just send that directly to me, and I will make sure that we get that incorporated as part of our program. So, so we will start with the beginning of sort of where we're going to start is the evaluations and sort of the market conditions, about sort of, especially in this sort of weird time. So we want to talk about, first off, we'll start with Chris and kind of work in the way that we did the introductions. Given all that's gone on and all the problems that we've seen over the last 6-9 months, what are some of the competing dynamics in today's market, and how are they impacting the current evaluations that you all are looking at, or target companies, or even your portfolio companies? So, Chris, you want to sort of begin that discussion about sort of what you're seeing and sort of market factors from a valuation perspective?
Sure. So I think the biggest thing, we've been through phases in this, right? Where we're back in March, April, May. I think people were questioning whether the economy was going to end, and business as we know it was going to be so hit that things didn't come back for another couple years. And we were quite pleasantly surprised at how quickly deals in general we started seeing again once the shutdowns really ended in earnest. I would say starting in early to mid-June, we saw quite a few deals start coming back to the market versus a very very shut down deal market, kind of coinciding with when all the shutdowns were happening nationwide. And now, one of the biggest element that I think in this goes to your valuation question is the big elements of uncertainty, which is that initially we saw major impacts from the shutdowns on both the negative side from companies that either operationally had to shut down their businesses, or on the positive side, there were certainly some businesses that ended up benefiting from some of the dynamics that took place that we just hadn't seen before. And with a fairly large portfolio of 21 businesses, we saw really all sides of those impacts. And it really varied by industry, varied by the company specifics. And so we continue to have just an awful lot of uncertainty. There's companies that have come back pretty strong after things opened up again. Some companies I think there's been some acceleration in the use of various technologies and things like that. That's been caused by this. But generally, the uncertainty part, I think, creates a dynamic that would impact valuations negatively. But on the positive side, I think we've seen that there's so much equity capital still out in the market, and specifically in the private equity industry. And the way that tends to work for those of you who are not familiar with it is that when funds like ours go out and raise a pool of capital from private equity investors, whether that be pension funds or endowments or wealthy individuals, those type people, they commit capital for a fund to go out and invest that capital over a period of typically 4 to 6 years. And the clock is always ticking, and I think there's a close to a record number of capital overhang out there right now. I think in total it's close to 900 billion last I saw. And that is firms like ours that are continuing to actively look for deals. And I think now that people are getting a picture that the world as we know it is not going to end. This is a large bump, but we're starting to see things come out of it, starting to see things function, and what kind of businesses can operate in this environment, or start to have a thesis of how they'll come out of it. Good deals, or companies that have visibility, are getting the same premium multiples that they were back in February before the world changed so much. One of the things you're seeing is the banks have pulled back a little bit, not a ton, but there is a little bit less appetite for lending than there was before this all happened. But you're seeing, I think, statistically, that private equity firms are just putting more equity in than they had to really fill that gap. I think the latest survey from GF data that puts out a good middle market type statistics showed that in the second quarter that multiples stayed very similar, but the amount of debt was a little bit less, so that hole was being filled by equity firms. So there's given the fact that there is less deals out there, the good ones are getting have all the more demand, and that's really keeping multiples at a pretty healthy level.
Cal, do you have any other sort of insights or different opinions from a PE perspective on valuations and current interesting dynamics in today's market?
Yeah, I was going to say, Chris hit the bullet points on my sheet here. I think the two big things, and again, Chris hit on one or both of these, is that don't forget there's the same amount of money that's chasing the total availability of deals, right? And that money didn't go anywhere. It didn't go away. So I think on broad brushstrokes, the gut feel is that total number of deals or deal flow is down, which in essence, there's still plenty of demand for those deals. So it's caused valuations to remain flat, in our opinion, and that was certainly something that we talked about back in mid-March and certainly April. And frankly, from a buyer's perspective, we've been in a hot climate, as you guys know, for almost 10 years now, certainly 5 years. So originally we had thought this may be that pendulum swinging back, and I'm not going to say it's been anything but that, because COVID has caused a really interesting thing where there's companies that have remained, I'll say flat or steady or sustainable through the environment. There's companies that have benefited from it. There's companies that have certainly suffered from it. And I think, to Chris's point, the companies that have proven to have an ability to project the revenue and hit the revenue budgets, even in a COVID climate, are fetching really, really premium pricing, particularly if you're over that kind of 10-ish million in EBITDA range. So when you think about different services and sectors and areas of the economy, you think food, right? Think food, think packaging, think some areas of healthcare where we're all going to the grocery store at record levels, right? Or somebody's going to the grocery store to buy food. So there's a number of different sectors out there that, like food, that have always been more recession resistant. And I think through a pandemic like this, it's proven to be just a great place to be. So some companies in spaces that have benefited from it more so than they would normally have been getting term sheets at just, in our opinion, very, very high premium multiples, where some spaces and some businesses in really any other climate would have been great businesses, but of that really, really felt COVID negatively, are unable to transact. So it's because of their decline in performance and the lending community not being able to get there. So it's a really, really interesting time right now where I think there's a number of businesses where in any other climate we would love to own, but COVID has really knocked them off the rails. So for those deals, they've been put on pause. But yeah, I think the overarching comment is there's no shortage of supply of capital chasing now a fewer amount of deals.
Okay. Robert and Steve, I guess, Robert, you want to provide sort of insight and quickly
Sure.
on the from investment banker or advisor side?
Yeah, I think we've experienced just about everything that Kyle and Chris were referring to. So we had a transaction that we had received indications of interest on in February, and we were going to do management meetings. I think it was the 3rd or 4th week of March. And so this company was totally unaffected by COVID. In fact, maybe slightly helped. And when we got to LOI stage in April, after doing virtual management meetings, the LOIs came in on average about 25% higher than the IOIs from the same groups. So I think that was an example of people, their world had fallen apart and they kind of realized if they wanted to get a deal done, this was a great deal to get done. We had another company in market at the time that was negatively impacted by COVID-19, but it was being chased by a strategic, and it was less negatively impacted than the strategic. So in the strategic's mind, it was a great situation to buy into because it would, they obviously felt their business would recover, and this was a business that hadn't gone down as much. We're in market right now with a company that actually Chris and Kyle both took a look at. Didn't fit for either one of them, but surprisingly enough, it's kind of a tough industry, and surprisingly enough, we have over 20 financial entities, buyers looking at it, along with a sizable handful, I guess, of strategics. So I think that speaks to Chris's comment that, hey, you got to invest. There's a lot of money out there. And then lastly, we're working with a team of executives to buy a company that was somewhat impacted by COVID-19, but the owners really sort of have to sell, want to sell. But I think we're going to get that company at a pretty good price because of their individual situation and the fact that they want to sell, and again, there aren't that many people looking at it. So four examples covering I think the 4 compass points of COVID.
Steve, do you have any other follow-up points or?
No, I think they covered it pretty well.
Yeah.
On the valuation side.
Okay. So do you have any comments you want to make, or we've got plenty of other questions that we can talk about. So.
Sure, go ahead.
So probably, one question is, the sentiment of the industry overall. I mean, what are we seeing in terms of sellers, buyers? I mean, obviously we've got the valuations and those are obviously playing in there, but is there a general overall sense of, an urgency to sell from people that are fatigued or uncertain about or is it sort of just normal course of business people that you're seeing, or is there, not the sense of urgency that that I see in some of the things that I'm dealing with from the transaction due diligence side?
I would use anything but the word normal these days. It's interesting. We're seeing a little bit of everything, right? And I think it starts with this logic or notion of, are we in a recession or are we not in a recession? And I think it largely depends upon just what end market, product, service, industry you serve. Folks that are in a recession, of course, you're going to get some guys who say, hey, I just don't want to see this thing, through to the other side. I'm 70, I've got grandkids, I've got another life that I want to cater to with family, versus some younger folks perhaps would say, no, that's not at all the right time to sell. In fact, I want to call, guys like Robert or, Chris Godwin or myself to take advantage of a depressed economy in my sector. So I want to raise capital to go out and chase, some add-on acquisitions, or I want to hire a bunch of people and build out some infrastructure. And then, throw on top of this, are we in a recession? Are we not in a recession? You've got COVID, you've got an election year. So it's just a little bit of the wild, wild west. And we're now seeing some folks say, hey, I'm not feeling so confident about the election. I want to sell, and I want to sell by 12/31. And, it's 10/1, already. So the clock's not ticking. I feel like the clock has already, tuck, if you will, or ticked. So we're just seeing a little bit of everything. But by and large, I feel like the deals, or at least the situations that are passing over our desks, are much more oriented and geared to, these recapitalizations where it's not a single shareholder or a group of shareholders just simply looking to sell. I think the last number of years, the scales would have been weighted in that direction. We were seeing a lot of deals where folks just said, hey, I'm done. I don't want to recapitalize and stick around. I want to sell 100% max valuation. Let's go, so I can lie on a beach. Now I'm seeing much, much more, 3 owners, only 1 wants to sell, or 3 owners, 2 wants to sell, 1 wants to stay in, and the few key guys want to be cut into the equity, right? Which is, that's a recapitalization by definition. So I'm seeing much more deals where folks, are trying to accomplish their capital needs with both buyers and sellers that are currently in the same business, which is interesting because that's what, GenCap and KLH do in any climate. So we've actually both been pretty darn busy.
Very good. Chris, you seeing the same thing, or is it, I would assume you're seeing similar things, or is there anything to add from a private equity perspective?
Well, I would just maybe add, we've kind of seen phases of the deal market, in that I would say the stuff we saw from June through the summer was, for the most part, was companies that I think were fully prepped and ready to go maybe in March or April. And just for obvious reasons, nobody knew which way it was up. And they were the businesses that held up, didn't have much COVID impact at all. And so those are the ones that hit the market. What we've started to see probably since Labor Day is more, over the summer, we didn't see many companies with what's been talked about as the COVID add back kind of analysis in the marketing materials. And so we're starting to see more of that. I think Kyle mentioned it, but we've been really surprised at the number of conversations we've had, either with business owners or in people in Robert's shoes, where they've told us they've gotten more than a few calls from owners that have said, look, this is the second black swan in the last 12 years. And, if as soon as we get some prospect that we've pulled out of this and we're not in, the direct hit of shutdown mode, we want out. Realize it's probably not going to be the top dollar, but we want out. And then we're certainly having more and more, I think, as well, we'll see how it plays out, but more and more fear of tax increases on the horizon. I actually think that 2021 could be a pretty good M&A year just because of that, if there is an administration change.
Yep. Steve, we don't want to, we're going to switch gears a little bit. And if you have something you want to talk about on the sentiments, we certainly want to hear that. But,
if you don't mind, let me just add on real fast.
Sure.
To what was being discussed. So From my perspective, part of what I saw during late spring and through the summer was the deals that closed, generally speaking, tended to be deals that were already signed before everything shut down in March. There were deals where they probably didn't close on time or in connection with the timeline that had previously been agreed upon or contemplated. But they were deals that still made sense to close. They worked through the closing conditions and figured out things like, MAC clauses, et cetera, and worked through all of that and decided to get deals done. But in terms of getting new deals signed up and signed and closed, that's been most of what I've seen recently has been stuff that was already in the works, typically before the shutdown occurred, and just to kind of set the table. Just so that we've got some facts, a little bit of stats in connection with all this. Global M&A in Q2 of 2020 was down 55% from Q2 in 2019. The number of deals in Q2 was the lowest quarterly figure since Q3 of 2004. And the decline was driven primarily by an 85% decrease in M&A activity in the United States compared to Q3 in 2019. Now, in Q3 2020, definitely you've seen a spike in deal activity, although it's really failed to take up all the slack after a lackluster start to the year. Although the first few months of the year were pretty good. Through Q3, worldwide M&A activity is still down 21% year over year. And as I was saying anecdotally, much of the Q3 M&A activity was really the resumption of deals that were left on hold at the height of the coronavirus pandemic. I definitely think that there are a lot of tailwinds that are probably going to continue to see deals getting done through the end of the year. I already hit on a few of the reasons why. There's a tremendous amount of dry powder in the private equity industry to be deployed. You have low interest rates, and there's a lot of market dislocation right now, which is potentially problematic for getting deals done. But quite frankly, the effects of the coronavirus haven't been uniform across the economy, as we're also talking about. And so there's opportunity that's been created by that. So I do think that it's probably going to be a pretty strong environment for M&A activity through the end of the year, but that folks are starting to get creative in terms of the way that they're looking at transactions. We'll hit on some of those strategies that folks are utilizing to try to get deals done as we dive deeper into the discussion. So Brian, I'll hand it back to you.
And kind of along those lines, I mean, obviously we've got all kinds of different things that are going on, from the impact of state restrictions, COVID, et cetera, et cetera. So, what are some of the specific mechanics? And this is probably, Steve, you're probably the best person to kind of start us off on this discussion, is what, specific mechanics or regards to deal documentation, or are they necessary to complete a transaction in this odd environment?
I could talk for a very long period of time about this. It's, as you can probably tell, I'm a bit of a deal junkie, and I love working through these things. There are a lot of different levers that can be pulled in connection with this in order to work through problems as you encounter them in a deal. But perhaps a place that makes a lot of sense to start in is really the beginning with letters of intent. I think that oftentimes buyers and sellers will sort of go back to their old playbook and tend to do the same things over and over again because they have success with them and because they're used to it and they're efficient in connection with being able to execute on those strategies. That said, given the level of uncertainty, the amplified level of uncertainty that exists with respect to companies' due diligence, the overall marketplace right now, and some of the challenges that are also facing companies, I think it makes a lot of sense to sort of examine anew what the strategy should be to acquire the company, whether it's an asset acquisition, an equity acquisition, a merger, whether you're going to do an acquisition out of a 363 bankruptcy sale, an 1123, whatever it may be. And then the other aspect of it as well is that given the various measures that have been taken by the government to try to help businesses along, it makes a lot of sense not only to get the lawyers, but in particular tax experts involved very early on in order to help with the planning, because the deal structure can have a huge impact on all the other dynamics of the deal. So I think it's important to get those folks involved early. And so just from a simple blocking and tackling standpoint, when you talk about letters of intent. In my opinion, the biggest challenge from a legal M&A perspective is the amplified uncertainty that's been created by the effects of COVID-19 on the marketplace and businesses. And so things to do would be including updating the standard LOI to reference new categories of additional due diligence or information as a result of COVID-19, such as business interruption plans, workforce accommodations, supply chain disruptions, etc. Increase the length of the exclusivity period to complete due diligence and to negotiate definitive documents. If a target has been severely or negatively impacted by COVID-19, potentially include a range of values instead of a specific price so that the buyer can further diligence the financials and the business operations and avoid anchoring to a specific number from the sell side. And if rep and warranty insurance is contemplated and referenced in the LOI, qualify that the reference should be subject to due diligence and negotiation of a rep and warranty policy acceptable to the buyer.
Kyle,
And,
sorry.
I was just going to say, and then from there, probably the next place after LOIs, unless anybody has anything further to say on that, is probably to talk about price considerations. And we touched a little bit on value, but perhaps we might also talk about earnouts as well.
Kyle or Chris, y'all have any other sort of something to add to the specific mechanics and deal documentation and sort of nuances as it relates to this current environment?
I think Steve has a much broader view probably than we do from our just specific kind of deals. So I think he covered it certainly better than I could.
So maybe this is a general question for the group in terms of the panelists. Obviously the taking on of PPP and is pretty broad within the current market. So what are the implications of your targeted companies or your current clients that have this that they're selling? What are the implications overall of having the PPP loans from a transaction perspective? And Steve, you have any initial thoughts as it relates to that?
Absolutely. So each applicant's loan amount was determined based on the applicant's pre-pandemic payroll, and it was designed to provide qualified businesses with the necessary funds to retain their employees, even if the business suffered material losses. And so as businesses with PPP loans begin to examine a potential sale, there really are several considerations that they should take into account, particularly to protect their ability to obtain forgiveness of any of the loans. And so, first and foremost, on the due diligence front, I think that PPP sellers should engage in their own due diligence process to protect their ability to be granted loan forgiveness. And the first step in connection with that is that the PPP seller, in order to actually receive the loan, had to make several certifications regarding its size, its access to liquidity, and an uncertain financial future as a result of the pandemic. And so given recent guidance provided by the SBA, it appears that the recipients of the loans will be required to reaffirm the certifications in order to obtain forgiveness. And given that it's important for a PPP seller to understand any circumstance that may prevent the seller, after having its equity purchased by a buyer, from truthfully making those certifications, the due diligence process takes on a fair degree of importance for them. And so in connection with that, they should seek information from the buyer regarding its size. The number of employees, for example, after applying the affiliation rules, whether it's the buyer's affiliates have any outstanding PPP loans received or applied for, and any other circumstance that might prevent the seller from having its loan granted forgiveness. For example, whether the transaction would increase the buyer's size or outstanding PPP loan amount above legal limits, which would jeopardize loan forgiveness, or whether the buyer is or is owned by a private equity fund, as it's likely that the affiliation rules would disqualify the PPP seller from being granted loan forgiveness. In addition to that, the structure itself of the acquisition, whether it's an asset sale or an equity sale, will have a huge impact in terms of the way that one would approach the sale and what the negotiating touch points would be in connection with the process. In particular, questions would be whether or not the seller could utilize any of the unused amount of the loan, and whether or not that, of course, the seller will be able to obtain loan forgiveness, but also covenants in connection with the operation of the business post-closing as well. So happy to dive into perhaps some key differences between asset sales and equity sales in this environment, but would love to get thoughts from other folks on the panel as well.
So, Robert, Kyle, do you have any specific, as it relates to PPP or how it's impacting you? It may not be impacting you really sort of at this point, but is there any sort of things you would like to add or considerations?
I'll throw in a point here. Neither of the companies that we recently closed had PPP, so it wasn't an issue. However, one of the companies we're in market with right now does have PPP. And a couple of the potential buyers have made it extremely clear that they will not take any potential liability if something blows up. So they are putting it squarely on our client's shoulders that either if it's not forgiven and they have to pay it back, it comes out of their pocket. So
are they opting escrowing whatever the amount is to take care of the potential liabilities as part of the transaction?
Well, I think to Steve's point, my guess is they'll probably go for an asset purchase as opposed to any sort of stock purchase, which is the norm anyway. But we haven't gotten to that point yet of the escrow, so we'll see.
Gotcha. So we've had a few questions that have been sent directly to me. So I thought I would sort of run through some of these and that would be relevant to the overall group. So and actually one of the first one, and I'm curious as to thought, because I've actually been involved with a number of our transaction due diligence practice has had a number of opportunities in the space. And so we've seen a lot more of spinoffs or non-core assets being sold by larger companies. I'm not sure if that is what you all are seeing or if that's just an anomaly that I've seen, but I'm curious as to Kyle, Steve, or Robert, if that's a increased factor during this time of COVID and trying to streamline operations, et cetera. So.
Say it again, Brian. It was the number of corporate.
Well, have you seen increased the number of spinoffs or sell-off of non-core assets? During this time of trying to streamline the process, get back to core operations, and just run a more lean operation. It may not be. I'm just curious as whether or not what you're seeing that in the marketplace.
No, we're definitely seeing more of them, right? And likewise, we saw a number of these back in 2008, 9, and 10, as some of the bigger companies, either had to pay down debt that was, racketing up or expiring debt. Similar to now, we're seeing some companies carve off non-core divisions and some divisions that aren't performing well, as well as likewise divisions or product lines that are performing really well, that could help drive some valuation to them. But yeah, I mean, we're seeing more carve outs and spin outs in 2020 than I have the last 5 years, right? Which makes perfect sense. Depending upon what and who comes with those carve outs, will make it either really attractive to us or not a fit, right? Because I think from the simple perspective of, can we partner up with an existing team, divisional president, team, et cetera, to help them buy out their division, right? We may be the equity that's put up, but we view that as a management buyout, right? How can we support them to continue doing what they're doing excellently, but just under different ownership? And that can be a great situation for the management team and for the divisional president, because we can grant them equity ownership. So once in a lifetime opportunity to be, an executive or an employee to now an owner, right? Some of our most successful deals have been corporate carve-outs and spin-outs because those folks know their business and product lines very well and can either be, handcuffed or hamstrung but once we unlock them or carve them out, you can service different customers, you can sell different product lines, et cetera. So we like to see them.
Kyle, or I'm sorry, Robert, or Chris, or Steve, do you have any follow-up discussions about, spinoffs or non-core assets being sold off in this environment, or the increase of it?
I think Kyle did a good job of covering that from our end.
Okay.
And I would say that those types of deals, of course, arrive on the desk of the investment bankers and the PE folks before it usually lands on the desk of the lawyers. But even so, I've already got a couple of different carve-out transactions that I'm working on behalf of clients as well. So it's already starting to trickle to my desk.
Yep.
We have seen an increase. We would normally work on the capital raise side of that. And we've seen an increase in people looking to do that. Probably 2 or 3, well, actually 3 or 4 so far this year, which is a lot of people coming to talk to us about it.
I know that I'm supposed to be the moderator, but I will add commentary this. So from our financial due diligence side, we've certainly seen in the last 3 months, 3 or 4 deals that are specifically on both the buy side and the sell side as it relates to either divesting or buying non-core assets from larger companies. So it is certainly a trend that I have seen personally. So with all the different things going on, what types of transactions are we predominantly seeing in this marketplace? Chris, Kyle, whether that be total buyouts or recapitalizations, or sort of what's the general trend of what the transactions have looked like?
Chris, you want to go first?
Yeah, sure. I think what we have seen is it's been a good mix. There's certainly been a decent share of situations where I think some owners are more willing to take on a financial partner, even if they're not ready to step out of the business completely themselves. I mean, I think we saw this back in coming out of the last big recession as well, where some of the owners just kind of want to diversify some of their holdings when it's the founder-owned kind of business. But at the same time, as I think I kind of mentioned before, we're seeing a good number of outright sales, either because people were kind of already teed up and they feel like the window could close here, or they something has happened because of this that's just made them think that life's too short. Maybe they let the cycle run a little bit too long and went out of the business.
Cal, do you have any follow-up?
Yeah,
Robert, or
yeah, it's really interesting because as we've talked, I mean, April and May deal flow was way down. It has come roaring back, but I think the proverbial, quote unquote seller that we were seeing in, really for the last 10 years, those deals have all, been put on the back burner, right? Unless the company has performed really well throughout COVID. So what I mean by that is we are now seeing a number of situations, I'd say more than just single shareholders looking to sell and move on to the next chapter of life. It's folks who are saying, hey, I don't want to sell, but my partner, Susan, or my partner, John, does want to sell. So help me get them bought out. But in fact, I want to stick around and grow, right? And to no surprise, that's a perfect situation for us. So, and again, I mean, that's a recapitalization in its purest definition. So we are seeing much more recapitalizations, and then likewise situations where folks are saying, hey, mom and dad own the business, they're getting up in age, They don't really want to weather another downturn. I'm the operator, but I don't own it. I'm a little bit younger. I'd like to continue the legacy. I may want to take it in a different direction or a slightly different direction than mom and dad, but all I want to do is get my parents liquid and gain a partner to go build the business that I fall asleep to, right? And that's a classic generational transfer. So it's been really, really interesting for Chris and me, and I'm sure Robert to a large extent as well, because that's, you take these founder-owned and these multi-shareholder-owned businesses that want to recap or that want to sell to their management team or that want to sell, to their kids, that we are seeing more of now as a percentage of the total deal flow. And that's exactly what we've been doing and looking for the last 20 years anyway. So it's a fascinating time, because the deal that passed my desk for the last 5 years that I would always pass on is the, hey, I just want to sell my business 100%. There is no management team that I want to cut into the equity. It's the maximum cash on the barrel price that wins the day. I'm going to retire. See you later post-close. I'm not seeing that deal anymore, nor am I the right buyer or partner for that situation. I never have been. So what that all means in a nutshell here is, I think deal flow continues to be down relative to certainly 2019, but a higher percentage of today's deal flow is actually overlapping with who we are, which has led to to how busy we are.
Okay, we got about 5 minutes left. I think that's correct. If I'm wrong, then let me know, Eric. And so if there's somebody who want to ask a direct question, I'm not sure how this works, but you can sort of raise your hand and I will unmute you if I can figure out how to do that. So if anybody wants to ask a direct question, certainly this is the time.
And Brian, while we're waiting for a question, just to opine on the last one as well, part of what I'm seeing right now is an uptick in the number of buyers who are willing to take a minority stake or a controlling stake, but not the whole enchilada in a target, and are oftentimes pairing it with a call option to either acquire control or to acquire the remainder of the target in the future. I'm seeing a lot of that. I'm also seeing more joint ventures than I would say is usual. So I think that people are looking to sort of defray and to share risk by partnering with others rather than necessarily engaging in a wholesale acquisition. We'll instead do the joint venture, possibly with various types of buyout rights built into that structure on the front end. And then, of course, also seeing a lot of buyers who are looking to be opportunistic in connection with acquisitions of distressed businesses, and in particular, either buying companies out of a 363 process, or potentially looking to work with companies that are struggling to work through some sort of pre-plan or pre-pack bankruptcy option.
I guess I'm not sure how I'm going to see the thing, so I don't really see.
It does not appear that anyone has raised their hand.
Okay, then I'm not just crazy. So then we have time for one last question, so I will take it a little more delicate. This may not be an answer. This is probably a question for Kyle and Chris in terms of your investors. And sort of given sort of everything that's going on, not just from the COVID perspective, but from just the general sentiment within the overall landscape of America, are environmental and social governance issues much more predominant in how you focus the money as opposed to the prior time, or is it really even come up yet at this point? So. You can defer and say
it has certainly come up. The conversations started last year. They have become more frequent. Reality is that it doesn't change what we do and how we do it, regardless of what happens or any change. So I wish I had more of a scientific response there, but we're not changing the sport of what we do, how we're modeling, changing valuations, what we're willing to pay, what we're modeling, et cetera. This is just kind of what we do, right? In every environment, in every decade, there's certain changes, both socially, politically, economically, et cetera. So it's full steam ahead. And the investors, for the most part, can divide, where their heads are at economically and where their heads are at emotionally. So it hasn't played a big role in the decision making.
The topic comes up and has been coming up for years. I mean, every time when you raise a fund with institutional investors and you have various state pension funds or those type limited partners, it's pretty common for you to have to fill out your ESG survey just to kind of give them a perspective on how those elements come into the investment process. But I think with the asset class being the private equity funds that are long-term commitments, that we've certainly seen the topic pop up for obvious reasons over the last 4 to 6 months or so. We have not been getting phone calls that further address the issue more than we have in the past, because it's a long-term commitment, and we've been producing returns in the same way we've done it for years, and so they certainly haven't expected us to change the way we're doing things.
Very nice.
I continue to see a lot of interest in the ESG space as well, particularly on the fund formation side. More and more funds seem to be incorporating that into the documentation that they're rolling out with and their investment pieces. In addition to that, working with at least one impact fund right now. I got another that's in the works, and they seem to be getting a fair amount of traction in the marketplace as well. And just more broadly speaking, just sort of reading the press, it seems that a lot of the ESG focused funds, a lot of the impact funds and the thematic funds are finding pretty good traction in the marketplace. And I think perhaps part of the reason for the uptick right now, in addition to the sort of the general market trend, is that a lot of the investing right now, a lot of the companies that are doing well and that are hot, sort of dovetail with things that are beneficial in a COVID-19 pandemic or post-pandemic environment. So there's sort of a lot of overlap at this point that I think is helpful. We'll see how long that lasts.
All right. Well, I think that brings us to the conclusion. I don't know if anybody has any parting thoughts, anything they would like to add. Robert, Steve, Kyle, Chris, this is sort of where we close it up. So I think we've covered a lot in an hour. So I don't see any people raising their hand. So I think we will, close it out at this point. So
I want to say thank you, Brian, for your help, all the panelists. Thank you, the steering committee, the sponsors. Remember, this event is put on by the FEI Dallas chapter. If you're interested in knowing more about the Dallas chapter, please reach out to myself or any of the other steering committee members on this call. It'd be much appreciated. We're about 550 strong and the premier financial executive group in Dallas, Fort Worth.
So thank y'all all for your taking time to come out, see us today. So
Thanks, everybody.
thank you. Bye-bye.